By the end of this video, you should know how to determine a draw on liquidity. That is the full meaning of this DOL, draw on liquidity. I'm going to explain everything you need to know about liquidity, where to see of where to find it, everything you need to know. I'm going to say it and break it down in this particular video. Okay, if you're following for the first time, I'm OLUWA-POUNDS and I used to drop educational videos on trading. Subscribe to my YouTube channel, share this video and save this video so you can learn if you are busy right now. Okay, and if you're not busy, calm down, bring your pen and biro. Let's dive into today's class. So first of all is, what is draw on liquidity? Now, listen very well. Draw on liquidity is a crucial concept in trading. It refers to how the market targets liquidity pool, especially located in the liquidity pool located in the high and lows of candles. Now, for example, in this particular place, you can see this is a candlestick and this is the high of this candle and this is also the low of this candle. Now, this high is our draw on liquidity and this low is also our liquidity. Now, we have the short-term liquidity and the long-term liquidity. I'm going to get to that. Okay, let's focus on this now. Now, this is the most important aspect of your analysis, and it should be your first priority in trading, locating liquidity, because liquidity moves the market. So if you understand and locate liquidity, you are going to increase your profitability in the market. Let's continue. Now, importance of draw on liquidity. Understanding draw on liquidity is crucial because it helps traders anticipate market moves by identifying the key levels. If you know and understand the importance of this draw on liquidity in trading, you stop joking around and learn it. Draw in liquidity shows you the direction of the market. You can see this is a bullish candlestick minus, let's assume that this particular bearish candlestick has not yet formed. This is a bullish candlestick. This is a liquidity high and this is a liquidity low. And this candlestick opened and price swept above it. If you master drawing liquidity, you should have already known that this is the next target here. Some people might be buying for mere, some might even be buying for mere, calling this a breakout. You are a trap. They might be calling this a breakout, but it's not a breakout. But if you understand draw on liquidity, you should know that after this sweep, we're expected to go down and take out this particular long draw on liquidity. Now let's talk about types of draw on liquidity. We have the short-term draw on liquidity and the long-term draw on liquidity. Let me explain it very well. Let's go back so I can explain this. Now you can see it clearly in this particular place. This is our short-term and this is our long-term. Now this was price open in this particular place. From here to here, calculate from here to here the distance from here to here and the distance from here to here. Which one is more longer and which one is more short? You can see this is the shorter one and this is the longer one. So therefore, this is our short draw in liquidity and this is our long draw in liquidity. Fast forward to here. If price should open above here, because this is a bullish candlestick, and remember what I said about bullish candlestick, price open below and close above. So this is the open and this is the closes above, and the new candlestick we open here. This is our short-term draw in liquidity. We're expecting price to move above here, sweep this liquidity, and come down and take away this long-term draw in liquidity. Now let's understand order flow. Without you understanding order flow, all this class and teaching is nonsense. Now, what is order flow? From the this thing now, order flow, something that is flowing, a stream. You understand? Order flow. We have bullish order flow and bearish order flow. The market is moving in a bullish form. That is what a bullish order flow. We are flowing in a bullish form. Forget the methodology in it. Just understand this. We are flowing in bullish form, and we are what? We are also flowing in bearish form. This is a bullish order flow. Why? Because you can see series of liquidity sweep to the downside and a pull to the upside. Price opens here. You can see this movement. This is the liquidity sweep. Price swept liquidity above here and continue moving out and moving up. Continue the same movement, swept low and continue going high. In a bearish order flow, price will keep on sweeping the high and continue going down, sweeping the high and continue going down, sweeping the high and continue going down. This is a bearish order flow. What is your job? Your job is to position yourself in between this liquidity sweep. Once you see the liquidity sweep, you make from the market and continue going up. If you see another liquidity sweep, you make from the market and continue doing what? Going up. The same thing in this bearish order flow. Follow the market. You understand? Follow the market. That is just order flow. Let's continue. Now, draw on liquidity. It can be seen in different forms. So the first one we have in our chart here is the candle range high and low. Remember what I taught you guys about Asian range, London range, and New York range. We have so many type of range. Now, this is our first 2 a.m. Asian range. This is the range. Let's call this our 4-hour time frame. Okay, but let's read this out. Draw on liquidity is the form of CRT. In form of CRT helps traders anticipate price movements more accurately, enabling them to take advantage of what? Of liquidity draws. This is the Asian range 4-hour candlestick, and this is the open of this particular candlestick, and price swept liquidity above. What are we expecting? We're expecting to go down. So remember, first of all, you mark out your range high and your range low. Price considers a short-term liquidity because price swept above this particular place and now targeting where? Targeting the long-term liquidity, which is here, and start doing what? Start purging to the downside. All you need to do is to go down to your 15-minute time frame and look for an entry model for in this particular aspect here. In this particular aspect here, and price should do what? Should take you down to this long-term draw in liquidity. Now, okay, under that particular candle range high and low, let me break down this this thing here. Let me break it down. Now you can see, first of all, is what? The generation of the liquidity. That particular one candlestick that generates that liquidity is this particular Asian range. The 2 a.m. candlestick is that particular candlestick that generates the range. That is where we can be able to mark our high and our low. Now, because this is a bullish candlestick, our short-term draw in liquidity is above and our long-term is below because we are expected to sweep high and go down. Do you understand? Now, secondly is the purging of the liquidity. A new candlestick need to form and purge this particular high of this particular range. You can see it here. Price will sweep above here, causing a liquidity sweep. And the third candle will now do the what? The expansion. This is the third candle, and the third candle will now do what? Locate the long-term draw in liquidity. You understand how you get this short-term and long-term? Go fast forward back to understand that. Okay, as easy as that. First candle does the range, second candle does this purging of the liquidity, and the third candle does the what? The expansion. Just like accumulation, manipulation, and what? Distribution. This is the accumulation, this is the manipulation, and this is the what? The distribution. Now, let's combine that particular order flow, this particular order flow movement in a CRT form. You understand? First of all, we are seeing under candle range high and low. You understand? So we have the short term. Okay. Now this is it. This is the particular movement. Now this is an what? Bullish order flow. This is a bullish order flow, guys. A bullish order flow, because we are, if you can see clearly, we are booming to the upside. What are we doing? We are going to be positioning ourselves in any liquidity sweep below to catch the next high or the next long-term draw in liquidity. Do you understand? Now this is it here. This is our sweep below. This is our next targeting area. Price targeted it and swept it above, creating a new low, creating a new high. This is the low we're expecting to sweep. You can see it clearly. You can see it clearly here that price swept this particular low and gave us a CRT movement. This is our CRT movement. After that CRT movement, price target where the next what? The next long draw in what? Long-term draw in liquidity. This is us joining the order flow. You can see it purely here. These are movement, these are second movement, and these are CRT targeting what? This next draw in liquidity. As simple as that. Now, let's talk about order flow and a bearish movement, or as in a bullish movement. First of all, this is our, listen attentively. This is our range. This is our range. Price creates this range and it's a bullish range. In a bullish range, we are expecting for price to sweep the high and this down to the low. You understand? Price did that, gave us a high, sweep this particular high, and purchase down and sweep this particular low, this particular long-term draw in liquidity. Now, after this particular thing has already occurred in the market, this now become our what? This now become our old low. And old low is what? Is our key level in the market. Old low is our key level in the market. After forming this key level, we now have a new draw in liquidity here, which is here. The draw in liquidity low and the draw in liquidity what? Our draw in liquidity high. If price should open here, listen, if price should open here, we are expecting price to sweep below here and target this particular place. Do you understand? Now, in our third form, you can see that price opened below here and did not sweep below this particular place. Price did not sweep it. You can see it. Price just closed inside the wick. Price closes inside the wick of it, okay, making this an invalid area, but the top of it still remains our what? Our draw in liquidity. The first draw in liquidity and the second draw in liquidity. Now you can see the next candle that opened. This next candle causes our liquidity sweep. You can see the sweep here. Price swept below it and starts targeting the first high and the second high. In our fourth illustration, you can see it here, the full expansion of it. The liquidity sweep, the first high manipulated, and the second high what? Taken out, giving us a clean and sweet entry. Follow this thing step by step, you will understand. Let's continue. Okay, let's talk about order flow and we see under order flow and bullish movement, combining the order flow, key level, and CRT together. We'll see under that. Okay, now a new example. This is our bullish movement. All this is our bullish movement. This is our key level. How is this our key level? LVG. This LVG over here is our key level. Now we're expecting price to do what? To come down and form a liquidity sweep or a CRT movement inside this key level. If price can do that for us, then we are going to the upside. This is the liquidity sweep over here. Price already formed the liquidity sweep, and our next candlestick should be what? Should be a bullish candle. Should be what? A bullish candle. We are going to position our buys from here, and this is the expansion and the movement, and this is the bullish candle what? Movement. I hope you understand. First of all, is the sweep, is the key level, the sweep of that key level, and what? Our bullish expansion movement. Now, drawing liquidity can also be seen in our previous day high and in our previous day low. This is a daily candlestick, and inside this daily candlestick, we have this daily high and daily low. Our liquidity, listen, our liquidity reside above here and below here. This is the short-term liquidity and this is the long-term liquidity. Why? Because after price will open here and close here and now open a new one. If price open this new one, which liquidity is the most nearer? This is near than this particular place. So this is our short-term liquidity. So price will have to do what? Go down and sweep below here and not target where? Not target the next high. With what I wrote here, you can see the previous day, week, high, and low are liquidity levels that can be used as a draw on liquidity. One of the easiest way to combine what? Draw on liquidity is the what? The previous day high and the previous day low. Let's continue. So now, under that previous day high and previous day low, let's break everything down bit by bit. We have 6 segments under that particular previous day high and previous day low. First of all is the close above, close below, week above, week below, close inside, close inside. All this means something, okay? All this means something. Let's break it down step by step. First of all, we're talking about the close above equals to what? Our higher prices, which means if you can look clearly, if this is a bullish candlestick and price created a new bullish candlestick and closes above this one, automatically this is our next draw in liquidity, because we're expecting price to close and also sweep it. So if price keep opening and closing above the next candlestick, that previous candlestick high will automatically what? Become our draw in liquidity. The same thing as this. If the daily candlestick closes below the previous candle, your next draw in liquidity should be the what? The previous day low. This candlestick open and closes below this particular candle, here is our draw in liquidity. This open here and close here is our draw in liquidity. The same thing going on and going on and going on. Secondly, is the previous day. Okay, under the previous day high and low, we have the third one is the week above equals to what? Closer and lower prices. And I say that if the daily candle closes with a large wick, we can expect a lower price, and our draw in liquidity will be in the previous day low. This is the candlestick and this is the very large wick, and we can expect what? A lower price of it. A lower price. Let me show you something. Let me show you guys something. This is a candle, and this particular, what happened here, this particular candlestick closes with this large wick. What are you expecting? A higher price. Do you understand? Okay. So, but this is a bearish form. That one I just showed you now is the what? Is in a bullish form. Let's continue. Now, this is our nearest draw in liquidity here. If this price should close below this particular candle. Now, here I said that if the daily candle closes with a large wick, you can expect a higher price, and our draw in liquidity will be in what? In the previous day high and low. This is our daily candlestick, and this wick is below. Remember, this wick is above, but this one is below. You can see the difference: above wick and below wick. If this is a below wick, we are expecting what? Price to push to the what? To the upside. Price to continue pushing to where? To the upside, because this is our wick. This our wick created is being formed below. Let's continue. The fifth one, we have the close inside. Lower prices if market is what? Is bullish. Now this particular segment is being conditioned by the market movement, if it's bullish or bearish. Now I said, if the daily candle close inside the previous day candle, we can expect a lower price, and our draw in liquidity will be in the next previous day low. This particular candlestick is called what? I think this is a pin bar candle or something like that. If you are doing price action, you understand? This shows that we are indecisive. Price does not know if it should go up or go down, go up or go down. You understand? And this can also be our range. And this candlestick opened and swept above it and did what? Ditch to the downside. The same thing to this particular one. Now I said this is a close inside candlestick. I said that if the daily candlestick closes inside the previous day candle, we can expect a higher price, and our draw in liquidity will be in the nearest what? On the previous day high. This is our candlestick here, and you can see price opened here and swept this low and closes inside here, giving us a high range CRT. If you are trading CRT, this is our high range CRT, because price did what? Swept this low and closes inside. So therefore, we're expecting what? We're expecting a more pusher to the what? To the upside. The same thing goes here. Price swept above and closes inside. We're expecting a more pusher to the where? To the downside. Now, next, you can say that our CRT can also be seen in this particular form, our range dynamics. Now, what is the range dynamics? This is where I think you can also add this as our Asian range, London range, or New York range. Everything are all in speculation of this particular range. You understand? So what do I say here? I say that these range dynamics are pretty simple. Very simple. You just need to identify the correct range, mark the high of this particular range, and mark the low. The 50% is what is your draw in liquidity. If price is sweep above it, we are targeting where the 50% and below of it. If price is sweep below it, we are targeting the high of it. As simple as that. It's very simple. You understand? It's very simple. Just mark your Asian high and Asian low. You can just mark it and wait for the first sweep above or the first or sweep below. Anyone. You understand? Example. This is our range. If you mark this high, you mark this low, price sweep above it, and continue going to the downside. This is our range again. You mark this high, mark this range low, price sweep above it, and do what? Continue go to the downside. This is a clear example. Our range high, our range low, price sweep this range high, and continue dishing to the what? To the downside. This is for a bearish movement. Okay. For a bullish movement, it's very simple too. Mark this range low, mark the range high, price sweep the low, and dish to the what? To the 50% and above it. You can look at the example here. Our range high, our range low, price sweep this range high, and dish that above. As easy as that. Okay? As easy as that. Now, let's add it with a CRT. I'm just saying about the high, the sweep, the dish starting. Let's talk about the CRT that's going to be formed inside of it. Okay? Now, inside the CRT, this is our range low and this is our range high. This is the sweep. That sweep must be a CRT sweep. If that sweep is not a CRT sweep, do not enter. We are looking for what? A CRT what? Sweep. This is a CRT sweep. Price closes, sweep the low and closes inside. The next candle should do what? Should do the expansion. Look at it here. Price sweep below and closes inside, and the next candle what? Does the what? Expansion. As simple as that. Let's add that with our key level. Let's add it with our key level. Adding that with our key level, you can see that this is a range low, our range high. Price swept below, giving us our what? Our CRT candle, and this start to the upside. Price swept, look in a remarket form. Price swept below, tapping inside this FVG. This FVG is our what? Our key level. Tapped inside this FVG and this start to this what? To our swing high. As easy as that. With this, you can be able to understand draw in liquidity. I believe by the end of this video, you already know how to identify your draw in liquidity in the market. I wish you success and I wish you good luck.